Imagine a company, right? And they completely bomb their earnings report. I mean, we are talking about missing consensus estimates on almost every single major top line and bottom line metric.
Right, just a total miss across the board.
Exactly. Revenue drops 13% year over year. Profit margins just compress to their absolute lowest level in over a decade. So, by every traditional logical metric, the stock should be in free fall the moment the opening bell rings.
You would think so, yeah. It should plummet.
But instead, Wall Street steps in and buys it aggressively. They completely reverse this multi-week downward slide.
Welcome to our deep dive. We are really thrilled to have you with us today for a special Talk Ticker session where we figure out exactly why this happened.
It is the ultimate market paradox. You know, you look at the spreadsheet, and the spreadsheet basically screams that the sky is falling.
Oh, absolutely.
But then you look at the trading tape, and the tape is telling you that the worst is actually over. Okay, let's unpack this, because in these Talk Ticker sessions, our whole mission is to strip away the noise. We want to get straight to the numbers, the strategy, and those hidden market signals of major corporate earnings events.
Which is exactly what we need to do with Lennar today.
Right. The central puzzle we have to solve for you today is unpacking this specific company's fiscal first quarter 2026 results. We have to figure out why a company can post what looked like a totally dismal quarter, and the market just rewards them for it.
Well, to truly understand this stock reaction, you have to realize that the market is, at its core, a forward-looking mechanism.
It doesn't care about the past.
Exactly. It does not care about what happened over the last 90 days. It cares about what the next 3 years look like. So to make sense of this rally, we have to look way past the immediate margin compression.
Which was severe, but...
Right. But we have to understand a massive multi-year shift in how homes are actually built and financed in America today.
So let's get right into the raw data. Let's do a rapid-fire, comprehensive summary of the Q1 financials so you know exactly what Wall Street was looking at.
Let's hear the damage.
First, the misses. Adjusted earnings per share came in at 88 cents. But the consensus on the street, they were expecting 96 cents. So an 8-cent miss right off the bat.
Which is pretty significant for a company this size.
It is. And revenue landed at $6.2 billion, completely missing the $6.88 billion consensus. That is a 13.3% decline year over year.
Yeah, a massive top-line contraction. And the underlying physical volume reflects that exact same pressure. You know, they delivered 16,863 homes in the quarter.
Which is down, what, 5%?
Yeah, down 5% compared to the exact same period last year. But where the pain truly becomes glaring, like the specific metric that usually sends institutional investors running for the exits, is the profitability.
The margins.
The margins. Gross margin on home sales was severely squeezed down to 15.2%. And just to put that into historical context for you, that is the weakest level of gross profitability this company has seen since 2009.
Wait, really? Since the ashes of the great financial crisis?
Exactly. And their net margin sat at just a razor-thin 5.3%.
Okay, so lower revenue, fewer homes delivered, and making way less money on the homes they actually do push out the door.
Right, it sounds terrible.
But, and this is key, it wasn't a complete catastrophe. There were a few bright spots buried in there. For one, new orders, which is basically the leading indicator for future revenue, were actually slightly up.
Yeah, they notched 18,515 new orders.
Which is a 1% year-over-year increase. And then you look at their balance sheet, and it's basically a fortress. They are sitting on a massive $2.1 billion in home building cash.
That is a ton of liquidity.
And their debt-to-capital ratio is incredibly low, down at just 15.7%. Plus, they're actively returning capital. They spent $237 million to buy back 2 million shares of their own stock and paid out another $123 million in dividends.
And that pristine balance sheet is really the anchor here. It gives them immense operational flexibility. But let's look at how the market actually digested this highly mixed bag of results.
Right, because the lead-up was brutal.
It was. Leading into this earnings print, the stock had been absolutely punished. Over the prior 30 days, shares had dropped 21.5%.
Wow.
Yeah, they had just snapped this brutal 9-day losing streak where broader home builder stocks were just being sold off heavily.
Basically in sympathy with rising bond yields, right?
Exactly. So the earnings hit the wire after the market closed. Initially, the shares fell about 1.2% in after-hours trading.
Which honestly makes total logical sense. If a student brings home a report card failing two major subjects, the parents don't usually increase their allowance.
Right. You miss the estimates, the stock takes a hit.
But then the sun comes up the next day, the regular trading session opens, and the narrative completely flips. The stock aggressively reverses course. It climbed steadily and closed up 2.62% at nearly $95 a share.
On huge volume, too.
Yeah, like 4.5 million shares changed hands versus a normal average of 2.9 million. So I have to push back on the logic here. Why did Wall Street reward this failing report card?
Well, what's fascinating here is that the market had already priced in a total disaster. That 21.5% drop over the previous month, that was the market expecting the wheels to completely fall off the housing sector.
Because of the mortgage rates.
Right. Investors were anticipating a devastating wave of order cancellations. So when the actual results came out, yes, they missed consensus, but they showed stabilization.
The new orders being up 1%.
Exactly. Investors bought the guidance and the operational efficiency. They looked right past the Q1 revenue dip because the absolute catastrophe simply did not materialize.
Okay, a relief rally. But to understand why margins compressed so drastically in the first place, we have to zoom out. We need to look at the brutal macroeconomic environment the housing sector is navigating right now.
Because no builder operates in a vacuum.
Great. And it all centers around one massive choke point: affordability.
Affordability is the single biggest barrier for buyers today. Throughout this first quarter, mortgage rates hovered stubbornly around 6.2 to 6.4%.
And then spiked back up to 6.11% in mid-March.
Exactly. And you can't look at interest rates in isolation. Combined with high national home prices that are vastly outpacing wage growth, the math just breaks down for the average buyer.
Put yourself in the shoes of a home buyer today, right? You are facing 6% plus rates. But it goes deeper than just the monthly payment calculator, doesn't it?
Oh, absolutely. The psychological weight is massive.
Right, because foot traffic in these new home communities is actually steady. People are showing up on a Saturday, walking through the model homes, but that urgency to transact is just gone.
Which brings us to consumer sentiment. Buyers are incredibly hesitant. Domestically, we are seeing real, pervasive, tech-driven job insecurity.
AI disrupting the workforce.
Exactly. If you're worried AI might disrupt your entire industry in the next 3 years, you do not confidently take out a massive 30-year mortgage at top of the market prices.
You sit on your hands, you renew your lease.
Right, and globally, the situation isn't helping either. There is immense macro instability. Specifically, management views the ongoing war in the Middle East as a binary wildcard.
And just to report impartially on how management sees this, they essentially believe it either resolves and the world stabilizes, or it triggers a massive shock.
Yeah, if it escalates, it triggers higher gas prices, which drives up inflation, which forces the Fed to keep interest rates higher for longer.
It's all connected. And then there's the political landscape in housing right now.
Right, the institutional buyers.
Exactly. Historically, these institutional home purchasers who buy homes to rent them out, they typically buy 5 to 7% of new homes. It's a reliable floor for builders.
But recently, they've been sidelined.
Yeah, due to popular sentiment and political pressure framing them as part of the housing problem. Plus, Washington is debating the 21st Century Housing Act.
Though management expects zero meaningful short-term impact from that legislation on actual housing affordability, impartially speaking, it's a long-term debate.
True. But the backdrop is just so conflicted. Builder sentiment fell to 36 in February.
Which is deep into pessimistic territory.
But at the exact same time, existing home sales actually rose 1.7% to a 4.09 million seasonally adjusted annual rate.
Which proves the demand hasn't evaporated. If we connect this to the bigger picture, we see a structural deficit. Years of underproduction means supply is critically short.
So the demand is there, it's just trapped behind the affordability wall.
Exactly, it's highly rate sensitive. So, if you are a builder, how do you survive this? You don't wait for macro conditions to improve. Management is actively choosing a production-first strategy.
Meaning the sacrifice margin to maintain volume?
Yes. The strategy is clear. Match the production pace with the sales pace. Do not wait for a rebound. Price to the market today.
And that strategic decision is what drove the painful numbers in Q1. The average sales price dropped to $374,000, down 8% year over year.
But the real lever they are pulling is the sales incentives.
Here's where it gets really interesting. When we say incentives, we mean mortgage rate buydowns. And these incentives sat at 14.1% on deliveries this quarter.
Which is massive. A normalized historical incentive level is usually between 4% and 6%.
So they are taking an extra 8 to 10% hit. They explicitly stated they are using margin as a circuit breaker to ensure affordability.
Yeah, they're paying the lender a lump sum up front, so the buyer gets a, say, 4.99% mortgage instead of a 6.5% one.
Let me use an analogy here for you listening. Think of an airline. Business travel dries up. They can keep ticket prices high and fly empty planes, or they can heavily discount the tickets just to keep the planes flying and the flight crews employed.
Right, rather than grounding the fleet.
Exactly. They take an 8 to 10% pure margin hit just to keep the machine moving.
And in home building, that is crucial. Stopping and starting production creates massive inefficiencies. It destroys relationships with your trade partners, the contractors, the suppliers.
Because if you stop building, the framers and plumbers go work for someone else.
Exactly. By guaranteeing consistent volume, even at a lower margin, the builder gets significantly better pricing from those trades. That negotiated discount offsets the margin hit over the long term.
Okay, so they bleed 14% on top to keep volume moving. The only way that works is if the operational engine underneath is incredibly efficient.
And that is exactly what justifies the market's optimism. Let's look at the direct costs. Direct construction costs dropped over 2.5% in Q1.
Which is crazy in an inflationary environment.
Right, and they are down 12% over the last 2 years. They're actually falling below pre-COVID levels.
Below pre-COVID levels. Wow. And it's not just costs, it's speed. The cycle time, the time to build a single-family detached home, dropped 5 days quarter over quarter down to 122 days.
An all-time low, down 11% year over year.
But the biggest piece of this operational engine is the asset-light pivot, the land-light revolution.
This is a huge shift in real estate finance.
Let's highlight this scale. The company ended Q1 owning only 11,000 home sites outright on their balance sheet, but they controlled 486,000 home sites.
Almost 500,000 plots of land.
Exactly. That means 98% of their land is controlled via options, not sitting heavy on the balance sheet. In fact, 86% of home sites delivered this quarter came through these land banking relationships. That's up from 52% a year ago.
It's a massive acceleration.
So explain this to us. How does a company control 500,000 plots of land without actually buying them?
It's all about option contracts. Instead of buying a massive tract of land and holding it for years, a third-party financial partner like a private equity firm buys the land.
Okay.
The builder pays them a non-refundable option fee, maybe 10% of the value. That gives the builder the exclusive right to buy those lots one by one, just right before they are ready to build.
And this insulates them from the devastating land value crashes we saw in 2008.
Exactly. They are transforming from a speculative real estate holding company into a pure, high-velocity manufacturing platform.
And we saw this recently with their partnership with TPG, right?
Yeah, TPG partnership to recapitalize Quarterra. TPG took a majority stake, committing capital to further accelerate this asset-light platform.
And the result is that their inventory turn increased dramatically to 2.5 times, up from 1.7 times just a year ago. They are turning dirt into cash so much faster.
Which is brilliant. But transitioning a 71-year-old company to do this requires massive internal technological transformation.
Right, the hidden margin lever. They just completed this huge ERP software transition, moving from a legacy system called World to a new one called E1.
And transitioning software at that scale is notoriously painful and expensive. Management actually admitted to paying what they called a dumb tax of early tech adoption.
I love that phrase, the dumb tax. It's so rare to hear a corporate executive admit to that.
Right, wasting money on unknown disciplines and bad paths initially. But those external consultant costs are now rolling off. SG&A overhead is expected to shrink meaningfully throughout 2026.
It's like renovating a kitchen. The first time you do it, you overpay for the wrong contractor. You make mistakes. But the second time, you know exactly what you're doing.
You've paid the dumb tax.
Exactly. And now they have this customer-facing tech, like a dynamic pricing machine that updates daily based on hyper-local demand.
It finds the exact mathematical breaking point of affordability for every single house.
And they implemented virtual customer care and 247 digital sales agents. This improved their average response time to customer inquiries by 35 seconds.
Which is a 71% year-over-year improvement. In real estate, speed to lead is everything.
Plus, product simplification. They are leaning heavily into an everything's included core product plan. Roughly 65% of the platform uses these core plans.
Which allows trade partners to build the same exact house repeatedly. It drastically reduces errors, municipal inspections, and build time.
So the framing crews know exactly where every stud goes without even looking at the blueprints.
Exactly. This raises an important question, though. If SG&A overhead drops because the tech consultants leave and the tech itself continues to drive down build times, what happens to profitability when demand finally returns?
Operating leverage.
Precisely. Which brings us to the forward guidance, the 85,000 delivery target, and the coiled spring thesis.
Right. Let's look at Q2 guidance. They expect orders of 21,000 to 22,000, deliveries of 20,000 to 21,000, and ASP flattening around 370,000 to 375,000.
But the crucial part is the margins. Management explicitly called that painful Q1 gross margin of 15.2% the low point for the year.
They are guiding Q2 margins back up to between 15.5% and 16.0%, and EPS guided to $1.10 to $1.40.
And despite the macro environment, they maintain their massive full-year target of 85,000 home deliveries.
Which is huge, but there is a massive narrative divergence here between management and the broader market.
Yeah. The media, the casual observers, they're still fixated on falling sales, 14% incentives, and tough conditions.
But management and the smart money see a coiled spring.
Exactly. Because when mortgage rates eventually normalize, that 14% incentive requirement drops back to the historical 4 to 6%.
Right, and that instantly returns 8 to 10% pure margin straight to the bottom line on this incredibly lean manufacturing base. They don't have to build any faster. They just start subsidizing the mortgage.
So what does this all mean for the stock? For it to break out, investors need to see Q2 margins actually hit that 15.5% floor.
Right.
They need to verify that the 85,000 volume target isn't a pipe dream. The strategy is coherent, but will the macro environment cooperate soon enough?
So what does this all mean for you listening? If you are watching the housing market, don't just look at the home prices. Look at the builders' incentives. That is the real shadow pricing of real estate right now.
That's a great way to put it, the shadow pricing.
And that brings us to the end of our deep dive into the data today, which means it is time for our signature Talk Tickers segment. Let me formally announce our transition into the This Is Not Financial Advice segment.
My favorite part.
As a reminder, we are taking the data we just discussed and stretching it to its logical, speculative extreme. Nothing discussed here is financial advice. So put on your analyst vest. Pitch us the trade.
All right, I'm pitching the everything's included coiled spring trade. The idea is to go long on out-of-the-money leap-wise long-term call options on this specific asset light builder.
Okay, go long the efficient builder.
Right. And simultaneously, you short a basket of traditional land-heavy regional builders and short building materials ETFs.
Wow. Okay, I have to laugh at the absolute audacity of shorting the underlying supply chain while simultaneously going long the builder. That's vicious. But mathematically, why does it work?
Because this company has pushed its direct costs below pre-COVID levels. They have squeezed their supply chain dry. That's why you short the materials ETFs.
Makes sense.
And right now, they are eating a 14% incentive cost. If the Federal Reserve cuts rates or the 10-year yield drops abruptly, this company doesn't change anything physically. They just stop offering rate buy-downs.
So an instant 10% margin expansion materializes overnight.
Yes. While the land-heavy builders will still be trapped holding expensive dirt they bought at the top of the market in 2022. They don't have option contracts. They have carry costs.
It makes complete mathematical logic.
Love it.
I love it. Well, that wraps up our deep dive, but I want to leave you with one final provocative thought to mull over today.
Let's hear it.
We talked about how AI is making consumers hesitant to buy homes today because they fear for their jobs, right?
Yeah, the job anxiety is real.
But think about the flip side. How long will it be until builders use that very same AI to design and sell the neighborhoods of tomorrow? If software can shave 35 seconds off a call and optimize a dynamic pricing engine, what happens when it optimizes the entire physical footprint of a new city?
That is a fascinating thought.
We would love to hear your thoughts on that. Remember, nothing we discussed is financial advice. Keep analyzing, keep questioning, and we will catch you on the next deep dive.